Welcome to the ONO trading floor. Big thanks to ONO for being one of our sponsors today. I am Sophie Dicker. I'm one of the co-hosts of You're in Good Company, which is an Equity Mates Media podcast. If you haven't listened before, have a listen. Tell us what you think. Always reach out to us on social media. But that's why we're not here today. We're not here for me today. We're here to introduce Joe Wright from Airlie Funds Management, who is going to be giving a 15-minute stock pitch for one of his highest conviction stocks. Before we jump into it, I do have to give a quick disclaimer, which I'm sure you've all heard 1,000 times today, but all information presented today is for educational and entertainment purposes only. Any advice is general advice, and we don't know your personal circumstances, so obviously if you're getting financial advice, please seek it from a professional. Equity Mates Media operates under Australian Financial Licence 540697. Please welcome Joe to the stage.
I've just got the mic. Got the mic. Can everybody hear me? Is that all right? Sorry if I don't get used to the circular room setup. It's the first time I've ever spoken in this kind of space, but I'll do my best to make eye contact with everyone. My name's Joe. I am an equity analyst at Airlie Funds Management. I've been in markets now for about 8 years, and I'm here today to give my high conviction pick. It's not something I actually like doing. It's a bit of a one-way bet, to be honest. It's a bit heads you win, tails I lose, because if I'm right, well, that's my job, nice one. If I'm wrong, I'm a moron, which I may be, but we can talk about that later. Anyway, it's been a tough year for punters. You know, buy now, pay later doesn't make any money. Crypto's shitting itself. NFTs are very much a scam. Nasdaq's down 35%. And a lot of people, I think, thought, oh, this is brilliant. You know, I've got a side hustle. I'm building a dual income stream. Probably just addicted to vaping. And so am I. And that's fine. It's time to look at some businesses where the business model actually makes sense. You know, companies that have real assets, that produce real things. The stock market is a get-rich-slowly scheme. There's a raft of high-quality businesses listed on the ASX, industrials businesses, material businesses, businesses that produce capital goods, businesses that extract and process raw materials. They look really cheap right now. It would be shameless of me not to mention that I am the materials and industrials analyst at Airlie, and finally have portfolio managers listening to me after about 5 years. So let's get into it. My high conviction pick today is, something you want to own. It's fast growing, it's high quality, and it looks cheap. It's James Hardie, a manufacturer of fibre cement building products for houses. Now, before I get into what the company does a bit more, it's worth addressing everybody's first thought when they hear James Hardie, which is asbestos. James Hardie, in the early to mid-1900s, was the largest producer of asbestos-related fibre cement products in the world. And as the negative health implications of asbestos were coming to light in the 80s, they ceased production, developed an asbestos alternative fibre cement product that is still in use today. And the company has had a publicly checkered past of managing its asbestos-related liabilities. But the reality is they are now committed to fully funding those liabilities. And ultimately, it's an issue that is well understood by the institutional investor community. But for those not as familiar with James Hardie as some people, I thought it was worth addressing, just out of respect for anyone who might have been affected by it. As we all know, though, the market is forward-looking, and James Hardie's in a great spot. Sales and earnings have compounded at rates of 15% and 20% over the past decade. It's high quality. Returns on capital comfortably sit above 20% through a cycle, and at the moment are north of 50%. Strong financial position. Balance sheet is great. Debt is less than a year of earnings. The share price has gone up threefold over a decade, is up tenfold over 20 years, and it's actually fallen 40% year to date, which for us puts it right in that hitting zone of interesting companies to look at. Before I get into why the share price has fallen though, and what exactly that means for you guys, let's talk more about what Hardie's does. Hardie's manufactures and markets fibre cement building products for interior and exterior building construction applications. Got that straight from the website. They basically make planks and panels that go on the side of a house. Fibre cement is effectively a mixture of cement, sand, water, cellulose fibres, and some secret source of chemicals. If you've ever touched it before, it's sort of like wood mixed with cement. It's really durable, but sort of gets manufactured in these large sheets and then is cut into different shapes and sizes depending on the final product being made. And excuse me a minute. And Hardie sells this product all over the world. They sell it in most countries in the world. But the reality is, even though it's an Australian company founded by Mr. James Hardie in 1881 and listed on the ASX in 1951, majority of earnings now come from North America, and this is where investors should focus their time. So, we know what James Hardie does. Fibre cement, building product goes on the side of houses. Who cares? Houses have been built with brick, wood, vinyl, through time. Why does fibre cement matter? Well, when you're building a house, you sort of ask yourself three things. One, is the material I'm building this house out of going to last? Is it going to be around for the next 5, 10, 20 years? Or am I going to have to do this again? Two, how much is it going to cost? And three, is it going to look good? And fibre cement sort of sits at the nexus of these three questions. It's very durable. It doesn't go up in flames like wood or melt like vinyl. It won't rot or peel or crack in wet weather. If you're one of those investors who really likes to get in the weeds and touch and feel the products of the company you're investing in, you get in your car, go out to the suburbs, you'll find a house made of vinyl and you'll find a house made of fibre cement. If you're a big strong guy, maybe you, sir, you won't be able to put a dent in a fibre cement wall, but you will probably be able to rip vinyl right off the side of the house. It has the consistency of a milk carton. It's nasty product, still used on 35% of houses in the US today. And so, from a cost perspective, fibre cement isn't always the cheapest up front, but when you factor in things like the cost of painting wood or the maintenance of fibre cement over its life cycle, maintenance of brick or wood over its life cycle, it stacks up really well. And finally, home builders love it. It comes in an endless permutation of colours, shapes, sizes. Stick it right on the wall. It's easy to install. It's not heavy. And so, from our perspective, it's a very compelling offering versus the other alternatives, or the more traditional alternatives. So, we like fibre cement. Why James Hardie's? Why not another manufacturer of fibre cement? Fuck, I've got a good answer for this one. They make 90% of the world's fibre cement. There is no competitor. That competitive position is a function of three things. One, they have a scale manufacturing position in North America that basically means their lowest cost of production in every region of the States. Two, they have IP around the fibre cement formula and the manufacturing process. And three, they have a cost structure in place with their distributors and the builders ultimately that allows everyone to earn a healthy margin. The dealers and the builders are incentivized to use this product because they make more money. And so it's really those three things that have combined over the last sort of 20 years to allow Hardie's to extract high returns on capital through time. So we like fibre cement. Hardie's looks like a good business, but it's already 90% market share. How much more can it grow? Well, even though it's 90% market share of fibre cement is still only used on 25% of new builds and 9% of renos. Hardie's has been growing volumes at 10% annually for a decade, and they've not even cracked the reno market, and renos are 65% of their sales. The opportunity to grow is right in front of them. 60% of houses in the US are over 40 years old, which means they're going to have to come down and get rebuilt or get renoed within the next 10 to 20 years. On top of that, most economists estimate the US is still short about 4 million houses. So we like fibre cement. Hardie's good business, big runway of growth. Why the fuck's the share price down 40%? Very obvious answer. I'm sure you've been hearing a lot about it. Interest rates. The market is assuming that rising interest rates will lead to a slowdown in US housing activity. Completely fair assumption. If I got up here and started arguing that there wasn't going to be a US housing cycle, I would get fired. So I'm not going to do that. The reality is, I think there will be a cycle, but I do think the market has already priced in a deeper cycle than is likely and is using the sort of GFC as its closest point of reference. Reminder, the GFC was the worst housing cycle on record. There's a couple of things I want to point out that are different to the GFC. One, US household balance sheets are in a much stronger position. On average, the average US household's equity versus the value of their home is 50% higher than pre-GFC. Two, in the US, in the GFC, we had housing starts go from 2.2 million, the highest peak ever, down to 500K, a collapse of 80%. There is just no way this cycle can be of the same magnitude, partly because we didn't even reach the same peak. And so how can the market contract as much as the most devastating cycle we've ever experienced? Seems unlikely. And remember, 65% of James Hardie's sales come from renovations, not even new builds. So if you're a US homeowner who's cashed up and you're worried about moving house because of the cycle, you're going to spend that cash on your existing home, renovating it for the next upcycle. If I model out, say, a 50% decline in US housing starts from peak to trough over the next 2 years, which would be the second worst housing cycle since 1971, not as bad as the GFC, but the second worst. I get Hardie sales down about 15 to 20%, earnings down about 30%, which puts the business on an enterprise value to EBIT multiple of about 16 times. That's in line with the ASX industrials. It's in line with where Hardie's traded at the past decade and below that the last 5 years. So from my perspective, the only thing that has to happen is the cycle will be less worse than the GFC and the stock looks at good value. The long-term growth opportunity is unchanged, regardless of a cycle. Seems like a pretty decent bet that I'm happy to take. It's a top 10 position in all our funds as a result of that. And I'm saying buy the dip effectively. You've got a great business, you've got a long runway of growth ahead of it, and you've finally got the share price back in the hitting range. To us, that's a compelling opportunity. That's it. No slides. I think we've got, if you scan your barcodes, there's a prize you can win in the Early Australia Investment Fund. Thanks for your time.
Equity Line.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.